Okay guys, I want to talk now, welcome back by the way, pair trading. Now pair trading is a strategy where you're trading the differential between two markets. You don't really care so much about what one individual market does. What you do care about is how the relationship of those two works. Let me explain what I mean. So you want to trade two things that are ultimately reasonably correlated. So let's think of some stocks that are correlated. You might have something like FedEx and UPS, both parcel delivery services in the US. The things that affect one will generally affect the other. You have something, let's say, Tesco's and Sainsbury's. Obviously, UK-based supermarkets providing food to UK consumers. They've got out-of-town stores. They've got the little metro stores. Very, very similar, just different brands. And then we can move on to something like gold and silver. Both precious metals have similar applications, both considered kind of safe havens. And then let's have a look at West Texas Intermediate crude oil versus Brent crude oil. Both crude oils, both different types of grades, different types of costs to crack them down into their individual fuels and individual components, but very, very similar. Okay, so let's have a look. So why are we choosing these anyway? The point is, when we're pair trading, we're looking for already a relationship of some sort. Now, in this case, it's a commercial similarity. What affects one is going to affect the other. The price of fuel, the price of delivery drivers, the economic environment of people ordering stuff online, how companies are using them, all that kind of stuff is going to affect each of those individually. So in reality, they should be reasonably correlated, but in actual fact, from time to time, they kind of come out of correlation for whatever reason. Maybe there's something to do with the company, maybe it's something to do with supply demand of one in particular, whatever it may be. And that is, as a trader, what we're looking for. We're looking for something that's ultimately correlated to go out of sync, and then for the correlation to come back into line, into a mean. So let's say we're plotting the FedEx divided by UPS, and we've got this kind of chart here, right? And this is like our imaginary mean line. And we, at this point here, we're thinking, you know what? This is out of line. FedEx is overpriced compared to UPS. So how am I going to make money for this ratio to come back into the mean? What we're going to do is we're going to sell FedEx and we're going to buy UPS. Now that means that if FedEx goes down, we make money. If UPS goes up, we make money. However, if FedEx goes down more than UPS goes down, we make money because we're short FedEx and we're long UPS. So we lose money on UPS, but if we're losing less than we're making on this leg, then we're kind of going to make money over time. And that's the same vice versa as well. So we're looking for the relationship as opposed to the specific direction. Mean reversion strategy. This is purely most of the time people trade this on a mean reversion strategy. Sure, you could trade this on a range expansion, but generally the reason you're trading this is that it's a mean reversing relationship. FedEx might be high one month, then UPS is high. And you're trading this yin and yang. If you trade like BP and Shell, for example, both oil refining companies, both oil exploration, all that kind of stuff, they will trade in a yin and yang as well. Look at Tesco and Sainsbury's, same thing. Why would we choose those as a pair? Because the same thing affects both of those. UK supermarkets got the big out-of-town retail stores. They do some clothing now. They do food. They've probably got the same suppliers for food. That affects then the pricing of the food, the wholesale cost of the food, the cost to acquire customers, the effect of other supermarkets and the German supermarkets hitting them from unexpectedly is going to affect them. So we can trade that and assume there's a correlation. And we may look at the charts and say, actually, they're not that correlated, but the point is we're looking for some relationship that we can get a grasp on. And when, let's say, Tesco's is really storming ahead, but Sainsbury's isn't, that's fine. But we can assume there's a lot of similarities there that potentially that gap is going to come back in again. So we would trade the relationship between the two. Another one we can look at from, let's say, a day trading perspective, and I knew a trader who did very, very well out of doing exactly this, is something like the indices. So the UK 100 versus the DAX 30. So FTSE 100 against the DAX. Why would they trade that? Because even though they're different countries and they've got different things that affect each individual constituent and each individual index, they're ultimately affected by the broad economy in Europe, in the world, and you would get instances where the DAX would just fly off, the FTSE would take a long time. So what would happen is that the DAX would then stall, the FTSE would kind of keep going before the DAX went again. And that was that sweet spot where the mean would revert back to normal, FTSE would catch up, just because of the pure volatility and the nature of the DAX being aggressive. And that would present, is the word I'm looking for, an opportunity for you.